What I get most excited about is bringing new life to the advisor, new energy, new possibilities, new solutions, greater confidence. We sit down with them and we help them understand asset allocation on a level they haven't really ever experienced.
There's the old famous 4 Ps. People, process, portfolios, and performance. A human being alone needs a process, something structured, something to work through. We bring our talents, our God-given talents to the table and make an effort to harness that with a process that's achievable, deliverable, understandable by people who want to join us.
What Equity Partners does is basically deal with and try and come to help and support financial advisors. That they are financially very successful, but they also have issues like, for instance, scalability. That what we do is provide a way and some tools that allow them to scale.
We specialize in the investment management part of that project, and process in investing is the most important piece in my mind.
Thane, it's so good to have you. And can you just help us understand a little bit about some of the pitfalls from your standpoint of why some of the classic portfolio models and the management systems, just don't cut the mustard?
Sure, thanks, Brett. And Ron touched on what I see on the portfolio management side being one of the biggest impediments is a traditional advisor usually will use an ETF portfolio, a mutual fund portfolio, because they don't have a team there to do the individual stock research. And it actually is better for your client to use a pool like that if you're not in the research business. But you start having trouble going after bigger clients when you do that. Your bigger clients, they want customization. They want some tax strategies that you can only do with individual securities. You'll do a good job competing on the smaller clients, but if you want to scale, your average client needs to grow the client size. So we provide a process where we have the team that does all the individual stock research, and it allows advisors that come on our platform to compete for those bigger accounts.
Let me bring you to what is the next thing and talk about the Equity Partners solution and how it truly is a growth engine that is an accelerator. And that's why we have this built to grow. Our primary contribution is to come alongside and help you grow. It's the bottom line. So why don't you talk through some of those things in terms of the alternatives to some of the things that you talked about before and Thane just addressed.
It's really difficult to go from making all of the decisions yourself on how much Microsoft to own to trusting somebody else. And having been in the business, your AUM is your asset. It's probably the largest asset your family owns. And it's a really big deal to trust third-party asset management. And I don't want to minimize that at all. And hopefully, as you get to know our team, that we're really good folks and very talented at what we do. But it is absolutely critical to have third-party asset management so that you can have a true institutional portfolio offering to offer not only your current clients, but in order to scale a business, and if you really are focused on growing a business, you have to go upscale. You need to go to that from, the $500,000 account to, raise your minimums to 2 million, 3 million, 4 million, whatever. I'm off script here, but, Thane and his team are currently, this year they've closed a $215 million account, and looks like they're on their way to closing a $120 million account. So I mention that just for credibility. We know how to close the larger account, and our mission, if we're going to scale your business, we need to move you upstream and get you in a position where you can close the 1, 2, 3, 4, 5, or $10 million accounts. But that really requires an institutional investment process. And that process it needs to be communicated in a very professional way. It cannot be communicated on a yellow pad. It needs to be a systematic approach that explains every component of the portfolio, that there's an engineered outcome that you're striving for your clients. And that can only really be accomplished through, having a team of people that have run some of the biggest pools of capital in the country.
But right now, Eric, I want to come your way now, because at some point in advisors' practice, they realize how quickly they become overwhelmed with research and searching for the right answers, et cetera. And tell us, more about how equity partners in the CWC business model can really help solve some of the problems that Ron has really helped to establish.
Well, so I think about the investment management process as kind of being multi-layered or multifaceted. And so, in one sense, it's an engineering exercise. You need to build model portfolios that do what they're designed to do reliably on the risk return continuum. So, think of that as the overall expression of a portfolio for a client who has a very specific risk return need. Underneath the surface of that engineering, you have the build out of the individual portfolios, including the stock selection. And so, Ron talked about my time at Russell, but I spent, the better part of a half a decade doing nothing but interviewing money managers who do nothing but full-time stock selection and investment management. And what you learn in that assessment is that doing this well and competing against a world of competitors who are doing nothing but stock research and portfolio construction daily, if you're trying to be a jack of all trades inside of your practice and you're doing so many things, you almost have no chance to compete effectively against that institutional manager that has a team of analysts and portfolio managers building these things. So you're at an enormous disadvantage if you're not outsourcing your investment management. So I kind of think of it as, is it practice management or is it investment management? And so when you partner with someone like CWC, you're acknowledging that specialization is better than generalist, being a generalist. And then when you partner with us, we do things like the institutional research into stocks, building thoughtful portfolios, making sure all the risk management is aligned with what we're providing. It's kind of like when you go out and buy a car, you don't ask about all the engineering underneath and you assume that it's very good. And let's face it, there's a difference between a BMW and a Volvo. They're engineered differently. So we spend all of our time behind the scenes thinking about those engineering questions, trying to build an expression of investment management that suits the client. We get you to that place with your client. We're worried about taxes and tax efficiency, discipline turnover. All of this frees you up to do practice management so you can leave the investment management to us and therefore maximize your time building your practice and building your business.
Today, you're going to hear directly from Thane and Eric as they kind of walk through their building blocks of how they do their portfolio design and construction. So Eric, you had to explain it simply. How does your portfolio design and construction process, use risk, source building blocks and create a, better and more confident experience for advisors and their clients?
Yeah, and I used a car analogy, so let's just continue to stay with that. When you think about these building blocks, they're the inputs to create a total portfolio solution, and we have a continuum of risk return portfolio outcomes that we've designed. And so I kind of think if you want a turbocharged car, you expect the turbocharged car to perform like a turbocharged car. If you want something safe and convenient, which can haul a lot, that's going to be very different. And so the engineering matters a lot, how you spec it out and how you build it. And so those models all reflect that kind of engineering that allow you to find the right portfolio for the right client type. When you think about that lower left quadrant in front of you, research, rebalancing, building, monitoring, trading, that's where you get into the nuance of investment management. And, Thane will tell you this. You don't want to get into the position of armchair quarterbacking the underlying holdings. So when you're doing what we do, concentrated stock portfolio management, when you look at a portfolio like that, you're going to see winners and losers in almost every environment. Don't focus on the losers or the winners, but focus on the total return of that portfolio relative to a benchmark. Because if you get caught up or focused in the individual name, you run the risk of starting to say, well, is the portfolio management any good? Winners and losers are all a part of investing, even with the world's greatest investors. So instead of trying to forecast which ones are going to win and lose, you go to the fundamentals. Which companies are executing well that you think are somewhat misunderstood, that you see perceived value that the market doesn't see, and you continually look for those and refresh the portfolios into your best ideas.
Good.
So that's why you want to leave it to us because the performance chasing game can become, let's call it vicious. It performance chasing is probably the greatest cost to investors of any cost in an investment program. It's extremely harmful. So I'll kind of let Thane comment if he has anything to add on that.
So I met Eric 30 years ago when I was
Whoa.
one of those managers that he was interviewing at the Frank Russell Company. And I know how many thousands of managers he's interviewed, and I want to thank him. The idea that he has chosen us to affiliate with after the end of that career is an honor, and I appreciate it very much. And Eric and I we think a lot alike, and in most areas, in some areas we think differently. But the challenge that he's brought to me and challenging my thoughts, and I challenge his, and the debate we get has, I think, brought the level of the overall investment management process up a great deal. He thinks in a macro basis where I've been more on individual stock selection for the last 30 years. And I focus the majority of my time on that. And he's brought an overlay of the macro that's been very helpful to our overall process. So that's enough saying nice things about Eric. I'll try not to do that in front of him. But to your question about how we transition portfolios, there's nothing easy about transitioning a portfolio that has high embedded gains. If you're coming to our platform, we just have to do it very thoughtfully and always with the client's best interest in mind. We always try to offset any gains we have to take with losses. In the kind of markets we've been in the last decade, we're probably going to end up with more gains that we have to take after that process is done. And we'll work with the client, work with the advisor to figure out what's appropriate. And if it takes us 2 or 3 years to ultimately get into these models, we will structure an interim portfolio that gets the same exposures to what our portfolio does, and really work for what is in the best interest of the client of getting them into our portfolios over a multi-year period.
Ron, I'm going to pass it your way, and before we kind of drill down on this, and then we'd love to hear more about Thane's strategy over the last decade and what makes CWC Advisors so effective in this. So, Ron?
Yeah. You know what I'm going to do is I'm going to defer to Eric.
So, we're looking at a total portfolio growth over time, and Ron shared statistics about how active management is done against underlying benchmarks over a long time. And that's not a mystery. That's true. A lot of people talk about it. Yet here we are with, trillions of dollars in the market still managed actively and most of them underperforming. So how has Thane done this? And, there are different philosophies about levels of portfolio concentration, how many stocks a manager should own. And what I found in my manager research is that oftentimes you get what I'll call benchmark hugging behavior, where somebody's really passive and they're not an active manager and they want to look like the benchmark and kind of do some things around the edges that look active. And I would say if you have minimal skill or no skill, hugging the benchmark is really smart. Like that's not a dumb thing to do. That's actually very advised if you don't have the stomach for genuine active management. What you're looking at here is a chart that reflects the views of someone who has been willing to take their insights and express them in a concentrated portfolio, not overly diversified. And that is the true way to express stock selection skill. If you need diversification or you need risk reduction away from what Thane is doing, there are ways to accomplish that by combining it with ETFs or broadly diversified portfolios from this camp of people that are, let's call it benchmark hugging. And so this brand of investing, which is focused, concentrated, based on true stock selection, is quite interesting. And if you peel the layers back and look at Thane's holdings, and you look at the kind of trading he's done, it's clearly a stock picker's portfolio. You don't see huge themes running through the portfolio. You see individual stories of companies that are doing something very unique or that have a pricing dislocation from the fundamentals of the company. They're built one stock at a time from highly unusual fact patterns that reflect the uniqueness of the companies and the stocks. So I just wanted to preface it by saying that and then kind of let Thane talk about what he does.
Well, thank you all very much. I want to make one point very clear. It's being referred to as Thane did this, Thane did that.
Come
I have a
on.
team
Come on,
at
Thane.
CWC Advisors is a team atmosphere.
that's
I
right.
am blessed to lead the team.
Yeah.
But Eric, Jeff, Eric here, Ty here, we've got a whole team here that's been doing this for a long time. And CWC is the one that's responsible for this track record, first and foremost. I also want to mention what we've mentioned GIPS compliant a couple times. Most people probably don't know that. It stands for Global Industry Presentation Standards. When you ask for past performance from an advisor, make sure you know what you're getting. GIPS is what is used when you're running institutional money. You have to use that. So this is the weighted average return of every account that we manage in the large cap value strategy. It's not the best. This is what institutions use when they're judging managers.
No cherry picking, in other words.
No cherry picking. Our goal in life, our team here, we get up in the morning because our goal is to outperform our benchmarks in each given strategy that we manage. We can't do it every month. We can't do it every quarter, but we provide a consistent implementation of a proven process that will not win every time, but wins enough of the times that over a long time period, we tend to outperform. And everything we do goes to making superior risk-adjusted returns. And there's all kinds of details we can go into I'll give you a very high level philosophy. When you look at the price of a stock today, that's the future discounted expectation of the investing public of what future fundamentals will be for a business. Our only job is to figure out what companies can outperform the expectation level that's currently built into the stock price. For the longest time, we looked for stocks that had relatively low expectation levels. That leads us to a value portfolio. And I'm going to steal a little bit of thunder here for some future slides. If you think about the last decade, at least the last 7 or 8 years, the stocks that have outperformed their expectation levels have been the high expectation stocks. It's been the Magnificent Seven, the guys that are doing great, big expectations, but outperforming. So we also use this same strategy to build a large cap growth portfolio. It has a much shorter track record, but the implementation has been good, and the performance has been good in that as well.
We're adding volatility and running the concentrated portfolio. Is that correct, Eric?
Oh, I mean, I'll take that. Yeah, absolutely. If you have too many stocks, you become very index-like, and your long-term returns are going to be the index return less your fees, for lack of a better term. So we will add volatility. Usually, having said that, the volatility on our large cap value portfolio is somewhat less than the Russell 1000 value based on how we pick the individual stocks, where our beta is 0.94 in this product. But by narrowing the number of stocks, you typically do tend to increase volatility. And what we've done, something that Eric's been instrumental in, is our alternative portfolio. And I'm really getting ahead of the slides now.
I know, but it's probably appropriate. Let's do that.
Yeah. Let's go ahead and go there. Yeah, you're good.
We have built an alternative portfolio that's not typical. It's more of an absolute return strategy where we want to make money in that piece of the portfolio every year. In 2022, when stocks are down 20 and bonds are down 18, we want our alternative piece to have a plus sign in front of it, hopefully 6 to 8%. And so we make up for the potential increase in volatility in running concentrated portfolios, which allows us the opportunity to add alpha in those portfolios. And then we dampen the overall volatility of the portfolio using an absolute return alternative piece. There, the secret's out. Sorry, it's over.
The engineering matters, and how you think about, like, people think about alternatives differently. And you could talk to a number of practitioners that might have a different a description that we do, but we're thinking of portfolio ballast, and we're thinking of quite a lot of liquidity. We're not chasing down a bunch of limited partnerships where you get locked up for multiple years. So we have a very specific kind of application here, which we think is appropriate for a vast number of investors. And you only have to live through one liquidity event where you can't get your money back for 6 years that you decide maybe that wasn't a great idea. So it doesn't, we're not eliminating the idea of illiquid alternative investments, but for this expression, it's best, we think.
Can you add just one more, just a little bit of color to your engineering that you and Thane implemented several years ago when you retooled the alternative sleeve?
Well, again, it kind of gets to Thane's comment that you're looking for an anchor to windward, or you're looking for ballast, so that when the storm's blowing, you have something that is doing some good and dampening volatility. And that's really how I think about alternatives. No correlation, or as low a correlation as you can possibly get to traditional assets, stocks and bonds, while producing some return. That's really what you want. And it's amazing to me how many dollars in the industry chase things that end up being folly, that where you look back on it, you say, boy, shouldn't have gone down that path, and I don't know if you'd equate it to 40 years in the desert or 400 years in the desert, but something like that. It's just oftentimes very much liquidity is so important to people when they realize they can't have it. And so we want to make sure we don't get stuck in that trap while achieving our goals. So it's a pretty narrow path that we're walking down, but we've managed to build a pretty nice alternative sleeve.
You just briefly, for the sake of time here, can you just do the large cap growth?
It will be quick. So it's identical strategy to the large cap value portfolio, how we implement it, concentrated names we like, and it's in names that are diversified throughout different sectors in the index. But it's the commonality are stocks that we think can outperform the expectation level built into the current price of the stock. And that has led us in many different directions, and it leads us to portfolios that don't look like the index. So the volatility we like is upward volatility, and that's the part we try to capture.
Give them a high level on this one if you could.
Well, I think the high level is we're aware of the benchmarks that we're managing to, and we're aware that when we're different from the benchmark, it's for a reason. Whether that's in the small cap strategy, and again, that's a stock picker's portfolio. If you look at those names, I would promise that most of them people will not have seen. It's very cool portfolio. And there's a discipline to it. There's a valuation discipline. There's a fundamentals focused discipline. When it comes to some of the international stuff, you're going to see, where CWC doesn't have edge, you're going to see exposure to global markets through vehicles that are low cost. And then where there is edge expressing in the form of, say, global themes, you'll see some names in there that reflect a little bit of a deviation from the global portfolio. And that's kind of how it goes.
Yeah, that's spot on. And where we don't have a theme, we'll use ETFs. Or where we don't have an advantage, we don't pick individual securities internationally typically, unless something falls to us that we really like. Similar on fixed income. We'll use individual bonds, but it's hard for us to build out a portfolio of 1 to 3 year treasuries more efficiently than Vanguard can. So if we want a 1 to 3 year treasury, we'll buy the Vanguard and pay them a beep or two. And then we'll express our thoughts in duration, moving duration in and out, and we'll do different pieces of the credit on bonds as well. You have not gotten paid to take risk in traditional bonds for many, many years. Credit spreads have been extremely tight, but we have gone into some of the private debt areas to try to increase yield a little bit, and that's been very successful. And the enhanced alts, we've already covered that. That's our sixth sleeve, trying to be absolute return and providing returns in all years.
Thane and Eric, you guys kind of, are going to help us kind of wrap up our time here. And let's go ahead and just kind of go, some of those core values of CWC, the investment principles. Thane, I'll have you go. And then Eric, I'm going to have you kind of talk about the fun that you guys have and kind of going back and forth and recognizing the sparring that sometimes goes in making this happen with the two of you.
Yeah, we've gone over a lot of the basic philosophy of how we look at things, but I think what helps to set us apart is our humility in knowing that at any moment, if we deviate from our defined structure, our defined process, if we think, boy, I've done really well last couple of years, let's take this big bet because I'm probably right. That's when the market will punish you. And the market's always bigger and better than we are. And you have to stick to your discipline, stick to your process, and realize that the people you're working for, that money is really valuable to them. And losing money is a terrible thing. It's happened a couple times over a 35-year career where you lose money, and those are not fun conversations to have. So we do everything we can to avoid that.
I think the secret sauce is what Thane said, humility. And, in addition to that, you want to be principally driven. You want to be adhering to investment principles, and those principles are linked to a philosophy, and all of that keeps a person anchored. And it keeps you from let's call it over betting, position sizing too much. It's so interesting to me when I think back over the arc of my career, and I think what have been like the most hyped stocks. Remember Global Crossing? That was one that supposedly Prince Charles was in, and everybody was talking about it. Huge hype, huge returns, till it crashed. And there are so many stories like that you don't want to buy into hype, but you want to keep a reasoned mind at all times, and always keep a risk hat on so that you're not sucked into an unrecoverable situation.
My partner, Gary Woolworth, and we started CWC Advisors 25 years ago. When we started CWC Advisors, it was clearly laid out. Thane, you're going to do the investment side. Gary, you're going to do everything else. He's in charge of making sure that the expectations and needs of running a business don't get in the way of running portfolio. And I would recommend that to everybody on the call.
We'd be honored to at least entertain a conversation about how we could possibly help you if there's a fit. I would emphasize that we're committed to your growth. One, two is we have capital to help you grow. And three, when you decide you want to exit, we would appreciate the first right of refusal to buy you. If you are a part of our system, you're probably going to be more valuable to us than anybody else. And assuming that you're a good fit, with our culture and everything else.